Let's now look at the subject everyone is ultimately concerned with, your financial situation. Detailed information on current finances is a key component of any business plan, particularly if it will be used to generate outside resources in the form of loans or equity investments. While many of your personal goals cannot be expressed in monetary terms, a certain level of financial planning is necessary for a farm operation to be viable in the long term. I have often said, if you don't make a profit, you are not sustainable. So, an accurate assessment of your current financial situation provides a comprehensive summary of the value of the physical resources available to your operation. It also shows you the income being generated by those resources in combination with human resources through your operations and marketing strategies. In addition, the strength of your financial position will determine your ability to access the capital resources you will need to add and use new resources in your operation. Your assessment of your farm's financial resources should answer the following questions as they relate to your holistic goals. What are our current family living expenses? How well has our business performed in the past, and how strong is our current financial position? What type of risk is our business currently exposed to? Finally, what is our current business environment, and how is it changing or likely to change? First, let's look at our financial needs. This covers our current family living expenses. If you and your family rely on your farm business as your only source of income, or as a major source of income that is supplemented by earnings from off-farm work, your operation can only be sustainable in the long run if it provides enough income to meet your family's basic living expenses. For most people, then, making a realistic estimate of current family living expenses is the starting point for assessing the financial status of your current operation. On a piece of paper or on a worksheet you can get from me, record your annual family living expenses and your family's earnings from off-farm work. The difference between the two is the minimum amount of income you need from your farm operation. Now that you know what you must make as a minimum, ask yourself, how well has our business performed in the past, and how strong is our current financial position? Your ability to assess the past financial performance of your farm will depend on the financial information that you have available. If you have access to detailed past financial information on your farm business, the process may be one of laying past year's information side by side in a trend analysis. If you do not have access to much past financial information, you may be limited to comparing information from past tax schedules. Although this approach of comparing tax records is widely used by financial institutions to assess financial performance, it violates one of the primary requirements of a complete financial analysis, that the analysis should be completed based on accrual, not cash, information. The first holistic financial planning class I took had a farmer state that if there was cash left over at the end of the year, it was a good year. This is not a reasonable way to assess your financial position. Why do I recommend accrual? Because it is easy to underestimate financial progress if you look only at the Schedule F tax information. One of the reasons for this is that U.S. farmers enjoy the unusual ability to report taxes on a cash rather than accrual basis. Most farmers find ways of continuously pushing income forward, consistently building inventories and under-recognizing income on their tax statements. So, by using the traditional method of many financial institutions of laying several Schedule Fs side by side, you are likely to underestimate the financial progress you have been making. On the other hand, you could be overestimating performance if assets are being used up and not replaced. So cash versus accrual information is one of the first adjustments to consider when you begin to evaluate your past financial performance and consider accounting alternatives. Another concern is market versus cost asset valuation. Agricultural lenders have traditionally evaluated farm financial performance based on the market value of farm assets. This gives the lender a basis for evaluating the risk faced by the lending institution and the collateral available in case a borrower defaults on a loan. Market valuation of assets provides the information demanded by external users of your financial information. What about your situation? Do market values give you the information you need for internal evaluation of progress? Using market values mixes net worth growth from farm earnings with growth from paper changes in the value of assets. So if you lay out your financial history using market values for assets, you can never be quite sure how profitable your farming operations have been, or even if your farm has been profitable at all. Market valuation is important if your goals include looking for external funds. Yet you should consider adding cost information to your analysis for your own evaluation of financial progress. To get a complete look at the past financial performance of your farm business, you should prepare the following statements to evaluate profitability, liquidity, and solvency: the income statement, the cash flow statement, the balance sheet, and the statement of owner's equity. We will discuss the income statement and balance sheet in detail, since these are probably the most important for farm business analysis. The income statement is a basic tool used to determine farm income for the past year. It shows whether or not your business has generated sufficient income to cover family living and tax expenses. To develop a historical net farm income statements from your available records, begin by listing gross revenue from market livestock sales, crop sales, services, government payments, insurance claims, patronage dividends, etc. Be sure to include any gains or losses from the sale of culled breeding stock, as well as the change in the quantity of raised breeding stock. Next, list all farm business expenses, including purchased livestock, changes in purchased feed, inventories, accounts payable, non-current liabilities, and depreciation expenses. Your net farm income is equal to the value of gross farm revenue minus total farm expenses. Now let's look at a balance sheet. A balance sheet lists all business assets and liabilities, showing what is owned and what is owed. In other words, the balance statement depicts your claim to the business financial assets, or what is called net worth and owner's equity. A series of balance sheets prepared at the same time each year for successive years shows the change in the business financial position and the progress you have made. A balance sheet can also be used to make accrual adjustments to your income statement. Assets include items owned by the business, such as land, machinery and breeding livestock, as well as items owed to the business. Liabilities include all claims against the business, such as accounts payable, credit card debt, the current portion of term debt, accrued interest on all farm loans, and taxes. As discussed earlier, if your balance sheets have been based strictly on market values, realize that not all of your net worth changes may have resulted from business earnings. Moreover, because farms and ranches typically are owner-operated, it can be difficult to separate personal and business assets. If your business is a sole proprietorship and you have included non-farm information on your balance sheet, be aware that net worth changes over time will reflect what was earned on and off the farm minus what was consumed in family living and taxes. Once you've prepared historical balance sheets and income statements, your next task is to look at the value of retained earnings generated by the business if one of your goals is to increase owner equity over time. Retained earnings can be estimated using the earned net worth change calculation. The earned net worth change is calculated by adding all non-farm income to net farm income. Family living expenses, partner withdrawals and taxes are then subtracted to arrive at a value that represents income that either contributed to or depleted the farm's net worth in the given period. Note that for family farms, the earned net worth calculation includes non-farm components, since the non-farm withdrawals for family living purposes are the primary draw on income, and because net worth growth can occur by bringing in income from off the farm, cutting living expenses, or improving tax management. Regardless of which method you use to evaluate past financial performance, you will find it useful to incorporate all this financial information into a trend analysis. This enables you to put everything together and document a financial history for yourself and for external stakeholders.